What is up everyone, this is Ali, and today in this video I'm gonna show you the best way to invest $1,000 in dividend paying stocks. Now before we get into this, I'm gonna get into the why. Why do I invest in dividend stocks? I do that because I hope over the long run my dividend payment will exceed my living expenses and I can retire off these dividend payments. The second reason why I do it is I love being in the game of investing. I love studying companies and figuring out what's a good investment, what's a bad investment, having the opportunity and the chance to beat the S&P 500. And if these reasons aren't good enough for you, then I seriously suggest that you invest your money in an index fund that tracks the S&P 500. That is one of the best ways that you can build your wealth over time and over the long run. If you like this video, smash that like button and let's get right into it. If you want to invest $1,000 in dividend stocks, these are the steps that you need to take in order to find the best allocation for your money. Step number one, find the company. Yes, one company. If you were gonna spend your $1,000 buying too many companies, you're gonna be paying a lot in commission fees. Commissions in Canada range from $6 to $10. In the US, some platforms are free, but some will charge you about $4 to $10 as well. With $1,000, if you're investing on that level, you're gonna eat up all your money just paying commissions. Plus, you can get enough diversification with buying one company, especially if it's a large and a blue chip company. Which brings me over to the second step. Step number two, look for size and moat. Try to find a company that has a market cap of around 50 billion or more. When you're dealing with a company this size, you're getting an advantage of it being involved in many industries and many businesses. Very high chance that it's probably doing business abroad, an international company that will give you that diversification. Now, moat. Moat is actually a term that you'll often hear Warren Buffett talking about, which is the strength of a business to keep doing business for a long period of time. Think of one of Warren Buffett's companies like Coca-Cola. Coca-Cola has a very strong moat because it has the strong brand and a very high chance of it doing business for the next 30 years. Step number three. Payout ratio. Payout ratio is basically the ratio of dividends the company pays out from its earnings. So if a company has a 50% payout ratio, that means it's paying half of its earnings to its shareholders in the form of dividends. When you're looking for a payout ratio, you want to have a payout ratio that's around that 50%. If you buy a company that's paying out a 90% payout ratio, that's very risky and that's very indicative of a dividend trap. If a company goes through any hard times or any recession, there's a very high probability that it's gonna cut that dividend because it's paying 90% of its earnings for the dividends. So if you find a company that has around 50, I usually go below 60. I feel that I'm comfortable with that number. It's been working out for me so far. Step number four, dividend yield. Try to look for a company that pays a dividend of around 3%. 3% is a moderate dividend. If you find anything that's really high, like a 6% or 5%, check out the payout ratio because that probably means that the company is paying way too much of its earning in dividends, and that's not very sustainable over the long term. Step number five, yield growth rate. This is by far the most important piece of information of this video, the one that you need to focus on the most when you're buying dividend stocks. Yield growth rate is basically the rate at which a company grows its dividends. I like to look at the past 10 years of dividends for a company before I buy it. I like to see if the company grows its dividend and the growth rate at which this dividend has grown over the past 10 years. I typically like to look for a growth rate of 7% or higher. The higher the better, because that means this company is stronger and is growing at a faster pace. Also, it means it will benefit you more in the long run. Now, to show you guys how important yield growth rate actually is, I kind of prepared a hypothetical example for you guys here for two investors, Mike and Emma. Both had $1,000 to invest and they planned on retiring after 20 years. They both took that $1,000 and invested it in a dividend stock. Mike went out with $1,000, bought AT&T, ticker symbol T, while Emma went out and bought $1,000 of Canadian National Railway, ticker symbol CNI. And they both held on for 20 years. If you look at the stats, at the time of purchase, AT&T had a dividend yield of 5.39%, where Canadian National Railway had a yield of 1.8%. The dividend growth rate, however, of AT&T was 2%, while Canadian National Railway has a growth rate of 16.8%, and that's over the past 5 years. They both held on for 20 years, and here are the results. You ready? This is gonna blow your mind. After 20 years, the yield on cost, which basically means the yield on the original $1,000 that was invested, for Mike is going to be 8%. For Emma though, it's gonna be 35%. Because of her dividends were growing at a very high rate over 20 years, she's now earning 35% of dividends on her $1,000. Now you might think, well, Ali, over the 20 years, Mike has probably earned more than Emma because he had a 5.39%, which is a much higher dividend than the 1.8%. You're wrong. Total dividend return for Mike is 234% over the 20 years, and for Emma is an amazing 273%, and that's just the dividend returns over the past 20 years. Both Mike and Emma won. They both won, but Emma won big. And that's the power of dividend growth stocks, is that you can have a really high yield on cost after a long period of time. Guys, if you like this video, I invite you to comment, like, and subscribe to my channel. I would love to have a conversation with you guys over in the comments down below. Also, for full disclosure, I am long Canadian National Railway. I love this company. It's one of my favorite positions in my portfolio. Also, I'm not a financial advisor. If you want to seek advice from a professional, please seek out a financial advisor. I am just sharing my opinions and my views on the stock market. So thank you for watching, and I'll see you in the next business video.